Hello, good Sunday afternoon. And for those of you who are enjoying your Sunday your Sunday football season. I'm fortunate and I'm a Denver Broncos fan, and the Denver Broncos played Thursday night, which they won and are now 4-3 on the season. I'm thankful for that. Plus, my New York Yankees are now in the World Series. Represent. There you go. My New York Yankees jersey on. But either way, let's get down to business here. Welcome back to Finom Group's latest video. As always, I'm your host, Seth Golden. Kind of wanted to catch up a lot of folks as it pertains to what happened there in September. And September's now bleeding into October. Um, and who knows where we'll be by the end of October, but we have some good ideas as to how the fourth quarter is likely to play out, barring any exogenous event. Exogenous events are not to plan for, they just happen. And when they do, you deal with it, right? An example of that is COVID 2020. Nobody was planning for COVID. And when it happened, as a human race, we dealt with it. Nobody was planning for a great financial crisis. When it came, we dealt with it. Nobody was planning for 9/11. When it happened, you dealt with it. So in that respect, we as investors, as traders, we focus on the things that we can control. And the things that we can control are how we behave, how we engage the markets. And, from our perspective at Finom Group, as long as you're using, to one degree or another, your three investing disciplines, things should go well for you over the long haul. And those three investing and trading disciplines are fundamental analysis, technical analysis, and of course, quantitative analysis. And we'll be looking at a lot of quant data series in this particular video. So what did happen? Everybody was looking for a down September. Everybody had all this data surrounding how September is typically the worst month of a calendar year. And that's all true. Even in a election year, it's better than the other years, but it's not great. Nonetheless, the way that we started certainly scared some folks, and we'll take a look at exactly how it started. But keep in mind what took place going into September, and that was a 4-month win streak. As you can see in this table here, this study by Steve Depp. Recall that going into September, the S&P 500 was on a 4-month positive return winning streak. Historically, this kind of bullish trend is very good for both in the interim and the long term, as outlined in the table. The one unique thing that we were able to discern from this study, and I'll give you just 10 seconds. What's the one unique thing that you see off to the left side, off to the left side there in the dates? What's the one thing that you can single out about 2024's occurrence that has never happened before regarding this 4-month positive return winning streak? Time up. It's the only one that went through the month of August. Right? It's the only one here that says August. Now, there was one that consisted of an August back in 1980, but even that didn't end in August, right? So what did that kind of say that we should, or maybe might anticipate regarding September? If no other streak ended, like that's it, 4 months is all you get, next month is down. If no other streak ended in August, serves to fit, why should it happen now? Why not a 5-month winning streak? And so that's one of the key points. One of the key principles of quantitative analysis is to look beyond the scope or the headline of this particular study, this particular data. Scan all the columns, see if something jumps out at you. And that was what jumped out at me, was there was no other August here. So something very unique was taking place here in 2024. And that's what I outlined to our Finom group members, our premium and our contributor members, uh, at the start of September. It's like, hey guys, there's something more here. I wanted all of our investors, all of our members to understand there's something more than just a 4-month winning streak going on here. So that was our first point of analysis regarding September. And then September started. And it started off pretty poor. Just like August, I'll remind you. We were down 4+% in the first 4 trading days of September. This study here from Fundstrat, the S&P 500 first 4 trading days of September, what happens by the rest or the end of the month, basically. There's never been a positive return for the month of September when you started out this badly. These are the 10 worst. He first picked out, or Fundstrat's team first picked out the 10 worst starts to the month of September. This is what they came up with, going all the way back to 1931. And here was the current one at the bottom, 2024, down 4.2%. Right? And by the end of the month, you have 0 wins, 0 positive returns when you start out this poorly, 0 for 10. And so, when you saw Tom Lee coming on CNBC and all the different financial media networks suggesting that, we could be in for a choppy, even a negative return period here through the month of September, you understand the data that they were looking at. I get it, right? You can't argue with this kind of data. Can you? Remember, this is just one data point. This is one set of criteria. This is a different set of criteria, a different set of data. This told us to be optimistic going into September. This told us things are going poorly once we got into September. But here's the other thing that we've known for a while. It's called the worst week study. And the worst week of the calendar year for S&P 500 returns is the 3rd week of September. Usually it's the 3rd week of September. It's the week after monthly options expiration most of the time, but sometimes it incorporates the monthly options expiration week as well. So this table here, the table below, is a study that we have tracked and trained our investing process to recognize why September has often provided negative returns. As the quantitative study informs, when the S&P 500 has delivered at least 2 consecutive weekly declines heading into the worst week, i.e. the 3rd week of September, the worst week also delivers a negative weekly return more often than not. And that's what you see here. The worst week's performance when you've gone into the worst week with 2 weeks of consecutive declines. So we had this in mind. We have this in mind every single September, not just this year, but every September. We've been tracking it. Right? We had all of this back tested data. But since 2020, we've refreshed it, we've updated, and sure enough, 2020 was a down worst week. Things were different in 2021. Unusual positive return. You can see the only other time it was positive in the worst week was 1989. But then again, lived up to, its form. We went into the worst week with 2 consecutive weekly losses, and sure enough, down almost 1% in the worst week of September. But here's the thing. Remember this study here from Fundstrat. This was the first 4 days, otherwise the first week of September, right? 5 trading days in a week. That was the first 4 days. The next week, the 2nd week of September, Holy crap, cheese and the monkey. That's mine, by the way. If you use it, it's copywritten. Send me a quarter. But we rebounded, is actually more than 3.5% that week. Rebounded basically 4% the next week. Now, remember, the third week is the worst week of September, but with this pod, there was no way that you were going to have two consecutive weekly negative returns going into the worst week. So the fact that that occurred, we had a positive week here. We could not satisfy this study, two consecutive weekly declines going into the worst week. We got optimistic again. We were able to get optimistic and start leaning more heavily into this unique circumstance. There's never been a 4-month win streak that stopped with the month of August. Follow me? So in terms of what went wrong, why did we get a positive return in the month of September? Again, this was a big reason. That was a big reason. Another reason from another study. So this is basically the fourth study we're looking at to surmise the probabilities of September. By week 3 of September, we had certain data that said, stay optimistic. This could be different. But here's one also from Wayne Whaley, S&P 500 performance after a 10% plus January through July and the first 2 weeks of August at a negative return. Everybody follow? 10% plus January through July, first 2 weeks of August were negative. Well, when you satisfied that criterion like we did here in 2024, guess what? September, for the month of September, scroll down, 12 times positive, only 4 times negative, 75% positivity rate. That's pretty darn good, right? So we essentially had all we needed. At least by week 3, the worst week of September, we had all we needed to recognize that we should lean in favor or lean into the probabilities that September would, in fact, deliver a positive return. And wouldn't you guess it? It did. Good stuff, right? Good stuff. Keep in mind this right here, October 27th through January 20th, a perfect 16-0. Again, when you've satisfied this criterion, which we did this year, October 27th through January 20th of the next calendar year, the market has never delivered a negative return. So whatever the closing price for the S&P 500 is on October 26th, the S&P 500 should be higher than that by January 20th. Look at the average returns, folks. 7+%. Now that means something for those of you who know another famous Wayne Whaley quant. Not going to get into it here. We discuss all of this stuff in our weekly research reports. Again, this was here in September, 3rd week. All of our Finom group members got, that quant. They got the additional Wayne Whaley quant that we're talking about here in this video, but won't go into details. And it's all the more reason why you should subscribe to Finom Group. Get our research every week of every month. Play chess, not checkers. You won't have to react to markets. You'll be able to anticipate the next move in the markets. Our contributor membership, you can get all of our research, all of our third-party research, all of our videos. Our premium membership, all of that, plus our investing, trading ideas, access to our Telegram, access to all of our points of communication, week in and week out. Access to our live daily trading room as well. All right, so That's what went right with September, folks. That's what went right. Here's the other thing that we understood. This is the Whaley breath thrust, also by Wayne Whaley. Recall that the Whaley breath thrust that triggered to achieve the July 16, 2024 all-time high. For those of you who are old enough to remember this year's primary peak before we had some consolidation and churn, the price of the S&P 500 to hit that peak and trigger a Whaley breath thrust. That closing value that day on July 16th was 56.67. Fast forward to October 16th. Why? Because that's 3 months later or 63 trading days later. And the positivity rate, nearly 86%. 86% of the time, the S&P 500, after triggering the Whaley breath thrust, 3 months later, the S&P is higher. So we knew, at the very least, there was a high probability that we were not going to go much lower or stay below 56.67 by October 16th, and wouldn't you know it? Once again, we were higher than 56.67 on October 16th this past week. I know everybody's aware we're well above 5,800 at the moment and going into our next trading week. But these are the kinds of studies that we analyze to have a better understanding and know the probabilities of where the market is likely to go over the next 5 days, 10 days, 21 days, 3 months, 6 months, calendar year. 100% of the time after a Whaley breath thrust, the market is never lower a year later. In reality, 58.50, let's call it for round number's sake, where we ended last week, is only not, roughly 200 points away from the Whaley breath thrust price. If you don't think we're just gonna stay here and not put that much more distance between the closing value of the Whaley breath thrust date and the next 12 months, which takes us to July 16th of 2025, I think you're kidding yourself. Breath thrusts are very powerful. I don't care what you think about geopolitics, neither does the Whaley breath thrust. You don't think we had geopolitics throughout history of the Whaley breath thrust? I don't care what you think about inflation. We've had inflation through the cycles as well. I don't care what you think about the national deficit. We've had deficits before. If you think about the modern era where we've been only growing our national deficit, well, there's 2009 Whaley breath thrust, there's 2019, there's 2020, there's 2023, and 2024. Whaley breath thrust and positive 1 year performance later has happened for each and every one of those where we've had growing national deficits. Don't put roadblocks, don't put obstacles in front of data. Don't do that. All you're doing is hindering your potential capital returns. All right, now I showed you with Tom Lee's, 0 for 10 after the first 4 trading days is this bad. In reality, folks, 0 for 20. The 20 worst for first 4-day start to September. It's the same thing. None of them delivered a positive return. I don't know a more powerful message to send to investors and traders as it pertains to the current market trend than to defy what happened here. Now, keep in mind, here's one other thing that never happened, and that's why you got to look at these studies carefully. Does this study really count? Does it give you a good representation of what's taking place in 2024? Well, first week, yeah, we've done that before. Have we ever done this in the second week of September? After down 4+%, have we ever been up 3.5% to 4%? No. So does this study apply to 2024? I would say there's no right answer. But if you ask Seth Golden, I'd say this is not consistent with this year's price action. Clearly. All right, moving on. 5-month win streak. So we had the 4-month win streak going into September, which we knew no 4-month win streak has ever ended in August. And guess what? That streak remains. But it also delivered a 5-month win streak. As shown in the table here from Ryan Dietrich at Carson Research. Again, what's so unique? I'm pointing right at it. No 5-month win streak ever ended in September. What does that tell you about October? You follow me? We just did this with the August and September, into September. We're doing it with September into October. How has October started? We're up a good 1% plus here in October already. I can't tell you. When you look at stuff that has never happened before, it doesn't guarantee what happens in the future. What it says is be open-minded because it's never happened in the past. Why should you expect it to happen now? Just keep an open mind. It's not a good predictor, but it does suggest you need to keep an open mind as an investor. Big picture, though, who cares about the 1 month, right? 5-month win streak through September. If we're down because something happens here in the final week or so of October, good, fine, great. As I've been informing our Finom group members, you want that. We would rather get a pullback sooner than later. And it all goes back to this study right here. Again, I'm not going to go into details as to why this percent average return is so important. But we would want a lower level for which to possibly deliver this return in this time period because it actually gives us a better signal for what we can anticipate in 2025. So yeah, I'd rather the market finish on a sour note here in the back half of October. I'd be perfectly fine with that. Either way, if it doesn't, it doesn't. The big picture for this 5-month win streak is look out here, folks. The next year after 5-month win streaks, only one time was the market red. And that was here, 2018. Now, remember what was unique about, well, not unique, but different than the current market environment, let alone monetary policy environment. I think I just told you, right? The Fed was hiking rates in 2018. The Fed has started lowering rates here in 2024. We have a very different monetary policy regime. 96.6% of the time after a 5-month win streak, the following 12-month period has delivered a positive return, and usually double digits. Coming into this year, folks, 2023 delivered 2 Zwig breath thrusts. Zwig breath thrusts are among the most rare and probably the most powerful of breath thrusts in the market. Essentially, the market goes down rather rapidly, but then has an even more robust rebound. You can think of it as a panic buying situation. And what's so relevant here about the Zwig breath thrust is it has a long tail of returns, similar to that of the Whaley breath thrust, which has a 100% positivity rate over the next 12 months. A Zwig breath thrust has the same thing, 100% positivity rate over the next 12 months. In fact, 6 and 12 months later, A Zwig breath thrust has never delivered a negative return 6 and 12 months later. That's a little bit different than the Whaley breath thrust. There have been declines 6 months later from a Whaley breath thrust, but that has never been the case for a Zwig breath thrust. But we had two Zwig breath thrusts last year. I call them the dueling Zwig breath thrust, right? And the only other time we had dueling Zwig breath thrust was in 1962, going into 1963. And I remember I first posted this chart in November in one of our weekly research reports to our Finom group members, because we only had one other occurrence. And look what happened after those dueling Zwig breath thrust in 1963, up, and away. More importantly, the biggest pullback you got in 1963 was 5%. I came into this year, 2024, after the dueling Zwig breath thrust of 2023, saying, projecting, anticipating that 2024 was unlikely, not just based on this, but I had no data to support a double-digit pullback or a full textbook correction of 10% in this calendar year. Oh, well, we got 9 close, but no cigar. It's not 10%. Okay. Nobody gives you a first place medal for coming in second. All right. Okay. We good? But this was the performance after those dueling Zwig breath thrusts. And this was the chart from early 2024. The updated chart. How we doing, folks? And this is why you follow this type of data. This is why you look for the kind of analogs that we look for based on the data, right? Almost textbook. 2023, 24 on the top, 1962, 63 on the bottom. Are you surprised? If you are, you're probably not a Finom group member. Get your subscription, folks, and do it sooner than later. Every single year we raise our membership fees. This is probably going up to 20 plus. This is probably going up to 80 plus. Get in while you can, folks. Lock in the rates that we have today. All right, next. Now, most of you may have seen this from my X post. Mark Newton calling for a 5 to 7 pullback through mid-November, and he gives all of his reasons here. A lot of this stuff has already cycled out, so why they're bulleted here is okay. There's nothing I can do about it, but they are. These are the rationale that he gave. One of the things that has already long since cycled is the DeMark exhaustion signal. I actually posted the DeMark chart and alerted to this at the start of September. That's why I say some of this stuff has cycled out. But, with respect to the possibility of a 5 to 7% pullback, I always say good. Down is good. In a bull market, in an expansion cycle, with credit spreads basically at multi-year level tightness, with disinflation and the Fed cutting rates, give me another opportunity to increase exposure to the market. I'm okay with that. Always think optimistically, folks. Again, with that Wayne Whaley study, folks, don't miss it. All right, now I've seen all kinds of analogs out there suggesting that we're going to have another 2007 into 2008 crash. All this garbage that people post on X. I kind of think about, the participants in social media and even financial media. You have to remember that a good 95% of people are not qualified to do what they're doing. They just do it. It's like they wear Nike all day, all night. They just do it anyway. It doesn't mean they're qualified. So be careful with what you absorb out there in financial and social media. With that being said, when I consider, well, is this going to, or some people are saying this is going to be just like 2021, right? When we got to like a 23 times forward PE multiple, which we're close to today at 22.1 or 20, 2.2. But look at the difference in the NYSI summation index, right? Ticker symbol NYSI on stockcharts.com. This is a New York Stock Exchange summation index. What's the summation index? Think about it this way. It's the biggest measure or broadest measure of market breadth momentum. Not just market breadth, but the momentum of that market breadth. It's the granddaddy of, hey, what's under the hood of that car? Types of measures, right? When we think about the price may of the S&P 500 might not be telling you what's going on underneath the surface, right? So that's what the summation index is. It's telling you beyond any reasonable doubt the health or lack thereof, and as it correlates to the overall market price. So here's where we are, 2024. Look at this, folks. Look at this trend. Here's 2021. We peaked early. In fact, at the beginning of the year, we peaked. The NYSI summation index peaked at the very beginning of the year, and it was basically downhill since, and essentially into 2022. So while the S&P 500 was making all-time highs in 2021, NASDAQ all-time highs, NYSE all-time highs, beneath the surface, not that good. In fact, bad. We were in negative territory. We were underneath the zero line here going into 2022. Does that look anything like what you see here today? Right? All we're doing is making higher lows here lately. And we got up to 1100 plus on the summation index. Okay, Seth, so not like 2021 going into 2022's bear market. Okay, fair enough, Seth. You tell us more about 2007, 2008. I am glad you asked. And there you have it, folks. 2007 going into 2008. Where are we in end of 2007? We are underneath that zero line, aren't we? Oh, and we spent several months well into negative territory. Again, does this look, and does today look anything like what you see there on the screen? No. For all these people, the market peaked in October of 2007. It was downhill from there. And it's October of 20, so it must be the same, right? Try again. Absolutely not. Next up, and I spoke about valuations just a second ago, but do valuations really matter? I always tell people valuations are not a timing tool, and you shouldn't be using a stochastic or a measurement of a market value that is static, not constant, but static, meaning it's ever changing. It's never, giving you a precise straight trend. Valuations expand over time, so it's static. How do you expect to use something that is constantly expanding with time to put a finite measure on what you should be doing based on any particular level of that PE value? When you sit down and think about some of the things that you hear and see other people doing in financial media, it's really kind of ridiculous, redonkulous, if you ask me. With that being said, on a normalized trailing 5-year PE basis, 2024 is the highest in history. Now, automatically, that sounds bad, right? The highest valuation in history carries with it a lot of negative connotation, and people don't want anything to do with that. Mind you, the previous occurrences, let's say 2024 doesn't exist. The second highest was in 2021. March 31st, 2021. 12 months later, the S&P 500 had delivered a 14% return. Before that, the highest was in 1997. 12 months later, 28% return. Don't deal with valuations. Don't let valuation dictate how you allocate capital. For the S&P 500, individual stocks, we need a whole nother video. With that being said, again, the streak that the S&P 500 is on this year, it's kind of remarkable, even coming into this year. The S&P 500 is up now 10 of the last 11 months. And when you have a streak like that, if we're thinking about the economy out to next year, look at the final column there. When the market has been up 10 of 11 months, you have to go all the way back to the Great Depression to see a recession out next 12 months. None of these other times has that happened. It's hard to fool the market. Market's not stupid. It has an ability, absent an exogenous event, to calculate the sentiment of millions upon millions upon millions of investors from around the world and incorporate that into price. And the price is a prognosticator, as shown here, the probabilities of recession out the next 12 months. Thinking of next year, the next 12 months, we haven't had a 10% correction in a year. October, in fact, marks the anniversary of the last 10% correction. What are the probabilities that we're going to go another full calendar year without a 10% correction? They're not good. Only 6 other times going back to 1980 have we had back-to-back years without a 10% correction. I would be anticipating some point next year a 10% minimum, a 10% correction. The average annual correction is 14% since 1980. Get back to your football game, folks. I hope you enjoyed our latest video at phenomgroup.com. Subscribe as soon as you can. We also have a webinar centered on quantitative analysis. If you've never studied quantitative analysis, if you don't know what quantitative analysis is, if you want to incorporate, this is next level stuff, folks. I've been doing this now for the last 6-7 years. Unfortunately, there is not a lot of tutorials, instructionals out there when it comes to quantitative analysis. This course is going to open some eyes for you folks. Have a great day. Take care.